Another method is IRR. So calculate IRR for project A. So we have to follow the same procedure. First of all, we have to calculate the payback period. Step 1, calculate the payback period, that is 12 lakhs initial investment by annual cash inflows. 12 lakhs divided by 4 lakhs. So payback period comes around 3. So step 2, find the payback period in present value of annuity table annuity factor table at fifth year row. So the value lies between 18 and 20%. This is the present value of annuity factor table. In fifth year row, the value lies between 18 and 20%. So payback period is 3. Here the 3 lies between 20 and 18. Actually it is 19 and 20, but for the safe side I am considering lower cost of capital, that is 18%. So at 18% factor is 3.127 and at 20% 2.991. Third step is we have to find the NPV, find or calculate NPV of both the discounting rates and interpolate to get the exact IRR by using the IRR formula. Okay, first of all, we'll calculate the NPVs at the rate of 18% and NPV at the rate of 20%. So present value of inflows minus present value of outflows. So NPV at 18%. Inflows are 4 lakhs. We have to multiply this 4 lakhs with the 3.127, which is the present value of annual factor at 18%, minus present value of outflows 12 lakhs. So it comes around 50,800. NPV at 20%. So at 20%, PV factor is 2.991. So NPV at 20%, 4 lakhs into 2.991 minus 12 lakhs. So it comes around minus 3,600. So now we have to calculate the IRR to interpolate these two percentage. We have to substitute the values. Lower rate is 18% plus NPV at lower rate 50,800 divided by NPV at lower rate minus NPV at higher rate. So minus 3,600 we have to mention like this into higher rate minus lower rate, that is 20 minus 18. So it comes around 19.87. So the IRR is 19.87 for project A. So for project B, same steps we have to follow. We have to calculate the payback period. So initial investment is 18 lakhs and annual cash inflows are 5 lakh 80,000. 18 lakhs annual cash inflows are 5 lakh 80,000. So step 2, find the payback period. In present value of annuity factor table, at 5th year row. So it is also the same. It lies between the same percentages, 18 and 20%. So we have to calculate the NPV for both discounting rates, and we have to interpolate these two percentages. So NPV at 18%, present value of inflows minus present value of outflows comes around 13,660. So NPV at 20% comes around minus 65,220. So to interpolate and to find the exact IRR, we have to interpolate these two percentages by using the IRR formula. So lower rate is 18% and higher rate is 20%. NPV at lower rate 13,660 by 13,660 minus of 65,220 into 20 minus 18. It is nothing but 2. Okay. So it comes around 18.34 for project B. Now we have to make decision by using the each technique as a decision making criteria. So which project is preferable if we consider the technique as a decision making criteria? So NPV for project A is 3,60,000 and 3,98,000. So NPV is higher in the project B. As per the NPV, project B is preferable. If we consider profitability index as a decision making criteria, then profitability index is higher in the project A. So project A is preferable as per the PI, profitability index. And if you consider the IRR for project A is higher when compared to the project B. So as per the IRR, project A is preferable. Okay, let us represent all these results in a single table. So NPV is higher for project B and PA is higher in the project A, and IRR project A. So decisions are as per NPV, project B should be selected as it has highest NPV. As per the PI, project A should be selected. As per the IRR, project A should be selected. This is how we have to calculate the net present value, profitability index, and IRR. So illustration 4. For better understanding, I'm just moving into one page. Okay. Devlex Limited has a mission which has been in operation for 3 years. Its remaining estimated life is 8 years. No salvage value. Current market value is 2 lakhs. Company is considering proposal to purchase a new model of mission to replace the existing mission. So company wants to take the replacement decision. So which one is better? Whether to continue with the old mission or whether to purchase the new mission. So cost of mission 3,30,000 and new cost mission is 10 lakhs. 11 years is the estimated life. Salvage value nil. For here, this is salvage value 40,000. So annual output 30,000 and 75,000. Selling per unit sales, and we have to deduct the operating costs, annual operating hours, labor hours, material cost, indirect cash costs. So we have to calculate the cash inflows and initial cash outflows, and then the company follows the straight line method of depreciation. So while calculating the cash inflows, we have to deduct the depreciation for tax purpose and we have to add it to the profit after tax. So corporate tax is 30% and does not make any investments, okay, if the yield is less than 12%. Present value of annuity of one factor. So annuity factor given for 12% cost of capital at the 8 years. Present value of 1 rupee, 12% rate of discount received at the end of the 8th year. So even for the 8th year also it is given that. So 8th year we have salvage value. So we have to convert this salvage value into present value by using this 0.404. Ignore the capital gain tax. Okay. Advise Devlex Limited whether the existing mission should be replaced or not. So first of all, we have to calculate the initial investments. So initial investment, initial cash outflow. So calculation of net cash outflows. The cost of mission, that is 10 lakhs. Cost of new mission less sale of old mission. Sale of old mission 2 lakhs. Old mission 2 lakhs. Net initial cash outflow, that is 8 lakhs. Second step, calculation of profit before depreciation and tax, and then net cash flows. So let us calculate the profit before depreciation and tax by considering the all elements. So particulars, old mission, new mission, and difference. Because this is the replacement decision, that's why we have to calculate the incremental cash flows. So if we consider new mission, what will be the increment? So annual output for old mission 30,000 and new mission 75,000. Because if we consider new mission, so the difference is 40,000, 45,000 units. Next one, sales per unit, that is 15 rupees in both cases. Sales per unit 15 into 30,000 and 15 into 75,000. So sales is 4,50,000 and 11,25,000. The difference is 6,75,000. And then we have to deduct the annual operating costs. Those are material cost, labor cost, and indirect cash cost per annum. So labor cost will be calculated with the help of operating hours. So 40 into 3,000 hours, and for the new mission 70 into 3,000 hours. Likewise, we have to calculate the labor costs. Let us go with the one by one. Less cost of operations. First one, material. Material at the rate of 4 rupees into 30,000. And the second one is labor. Old mission 3,000 into 40 rupees. 40 rupees per hour. And for the new mission 70 rupees per hour. 3,000 into 70. So it comes around, the difference will comes around 90,000 rupees. So another cost is indirect cash cost. Indirect cash cost 50,000 and 65,000. The difference is 15,000. Now profit before depreciation and tax. It comes around 3 lakh 50,000, 8 lakh 15,000, and 4 lakh 65,000 is the difference. So by using profit before depreciation and tax, we have to calculate the annual cash outflows. So particulars, same columns we have to maintain to get the incremental cash flows. So profit before depreciation and tax. Now we have to deduct the depreciation. So depreciation we have to calculate for old mission as well as for new mission. So old mission, the cost of old mission is book value 3,30,000 by 11 years. So as per the rule given, we have to follow the straight line method of depreciation. So in this sense, 3,30,000 divided by 11, that is 30,000 per annum. For a new mission, we have salvage value here. So 10 lakhs, sorry, 10 lakhs, and we have a salvage value in 8th year. We have to deduct it and then divide it by how many years? 8 years. So depreciation will be 30,000, 1,20,000. So the difference is incremental depreciation is 90,000. Now profit before tax. We have to deduct the tax at the rate of 30%. So it comes around 39,000, 1,29,000 and 90,000. So after deducting the tax, we'll get the profit after tax. So we have to add the depreciation to this profit after tax. Whatever we deducted earlier for tax benefit, we have to add it again. Now we'll get the annual cash inflows. So annual cash inflows for old mission and for a new mission. If we consider the new mission, the increment will be 3 lakh. So the final step is calculation of net present value. PV of inflows minus PV of outflows. PV of inflows includes salvage value. So incremental cash flows from 1 to 8 years, that is 3 lakhs. 3 lakhs per annum. This figure. And we have to convert into present value by using the present value factor. So present value of annuity factor in the 8 year, for 8 years 4.968. 4.968. So we have to convert the salvage value. So at the end of the 8th year, with the 8th year salvage value, that is 0.404, 0.404, 8th year salvage value. It comes around 16,000. 16,160 less PV of cash outflows. PV of cash outflows. So PV of cash inflows are 15 lakhs 6,560. So we have to deduct the cash outflow so that we'll get the net present value, that is 7,06,560. This is how we have to calculate the incremental cash inflows and NPV. And that while calculating the replacement, while taking the replacement decision, we have to calculate the incremental cash inflows first and then NPV.